Okay, let's go. So, I guess if you think about it, with depreciation, a business will choose based on how, if you like, what they believe their use of the asset will entail, a percentage that's fair and reasonable. And the same thing really is what's going on here. The government, in its mind, assigns a percentage of what they feel is a reasonable, acceptable percentage, a standard percentage. And therefore, we start off by talking about the pools, the first main general pool, if you like. That's, of course, referred to them as the main pool. And then we have all the little quirks around this, which is their way of influencing behavior. So, generally, again, expenditure on plant and machinery will become part of this main pool of expenditure upon which capital allowances are claimed. And assets are pretty much added together. These plant and machinery are added together, and then just, if you like, the percentage, which is 18%, you'll see it in my next slide, is then, if you like, put on 18% of that cost that we talked about earlier on. So the initial cost plus subsequent expenditure. And whatever it is you arrive at becomes your allowable capital allowance, if you like. And so that's the general thinking. And the truth is that most items will go into the main pool. In fact, normally you would imagine that all items should go into the main pool. And typically all machinery, and cars, for the business, of course. So where are we talking about now? We're talking about new cars, second-hand cars, and most cars do have CO2 emissions within this sort of range of 76 gram to 130 gram per kilometer. Now, the reason why this is showing up here, second-hand cars, because students sometimes sort of assume that once a car has a CO2 emission of this, which is a government, and we'll look at that, we'll see that on the next slide, where the government's trying to encourage people to buy these type of cars, is because they're second-hand. The argument is someone's already claimed the initial benefit that the government gives for you buying this thing, this sort of car with 75 grams or less. So from then on, it's just really falling into the main pool. So most things will attract capital allowance of 18% in a 12-month period. Again, we'll talk about the quirks, but typically, let's assume every business will operate a 12-month period. Plant, machinery, and everything bought in that year. Normal cars, second-hand cars will fall into that category and attract 18%. Now, again, like I said here, now as you can imagine, to encourage or discourage certain behaviors, the government can use this tool to achieve some type of economic goal. So if they wish to encourage, as they do, to encourage the purchase of electric or low emission cars less than 75 ones, as in the new purchase, I should put here, these can be treated separately and will enjoy 100% capital allowance. And that's referred to as a first year allowance, an FYA. And you always enjoy that. So you buy that thing. It doesn't matter when you buy it during the year. So if you bought this new car with electric car or whatever, or a car that had these emissions, you can, if you bought it for 10,000, you can express, forgive me, I was interrupted there. So I was talking about these first year allowances, and businesses, if you like, can enjoy this first year allowance of 100% because the government's trying to encourage people to buy them. So yes, you buy it for 10,000, you are allowed to deduct the full amount of 10,000 and declare that and use that as a capital allowance. Remember, all these will come off, will be considered as, if you like, as expenses or adjustments to your net profit in arriving at your tax-adjusted trading income. Right. So, if you like, on the other sort of end of the spectrum, at the other end of the spectrum, the government, to discourage the purchase of new or second-hand cars with CO2 emissions in excess, forgive me, of 130 grams, you can't, you're just not allowed to include that in the main pool. But what you do is you have to put this in a separate pool, just because you're polluting the earth. So what you should do is put it in a separate pool, and that's called a special rate pool. And here you can only enjoy 8%. So you can't enjoy the 18%. You can only enjoy 8%. So whatever it is, you buy this car for 25 grand, take 8% of that, if you like, and then put that through as your capital, as part of your capital allowances. And then of course deduct the 8%. It's kind of like a net book value. It works. You practice this very much net book value style, or reducing balance method style. Right, you take 8% of the net book value, and you keep going, as you do 18% on the main pool as well. Now, some other things that just can't go in the main pool. If the owner, this is important, you see exam questions to try and trip you up a little. They'll tell you if an employee, no problem if an employee uses a car for their own personal use. If the car belongs to the business, and the employee will have to deal with the personal benefit they gain from having a company car. But if the owner himself uses any of the cars for their personal use, then the asset cannot go in the main pool, but it goes in a separate sort of pool. It just goes on its own pool. And you, let me see if that's on my next slide. Well, we'll talk about that when we get there, but that can't go in there as well. So hopefully you're beginning to see some of the kind of things that just can't go in the main pool. But mostly everything goes in the main pool, except, like I said, this idea of the new cars, which you can enjoy, that doesn't have to go in the main pool, that goes in its own pool, enjoying 100%. Then you have this big cars that can't go in there, and have to enjoy 8%. And this can't go in the main pool, but we'll still enjoy 18%, but just that only the portion of the, so if the owner was using a car that was worth £10,000, you would work out 18% in its own pool. First of all, you make your own pool, so that would be 1,800. But then you would only be allowed, if he used 30% of it for private use, well then only 70% of this would be allowed as the capital expense. And a business can choose, if it feels that we're not going to be holding this asset for a long time. And we'll see in a second, if they believe they're going to be holding an asset for less than 8 years, then they may, as you can imagine, you see the 18 times 8 kind of brings us to 96% roughly. So you can see that the 18%, you see where I'm going, the 18% times 8 years. And it kind of, if you think, well, I don't want to hold it, keep it in the main pool for, if it's going to be, if I'm only going to hold it for 2 years, for example, or 3 years, by leaving it in the main pool, the problem is that you have the potential to gain what's referred to as balancing allowances, and you can't calculate a balancing allowance within the main pool. So balancing allowances only happen at the end when the business is sold. So if you want to take advantage of any balancing allowances, you need to give it its own pool. But that's because you intend to sell this asset pretty much before the end of its life. Again, yes, so that's, I just sort of highlighted that. And then finally, or I think finally anyway, we have the last set of things that can't go into the main pool, are these ideas of long life. We have these long life assets. So pretty much assets like air conditioning, assets that will last for over 25 years, basically. They're going to be there for a long time. So as you can see, that kind of makes sense as well, because the government pretty much expect that the assets in the main pool will be around for 8 to 9 years. So once you're talking about anything that's lasting 25 years, well, you go into the special rate pool where you're really at 8%. So, and even that is quite fair, because at 8% the government are pretty much saying that we think it's meant to last for about, if you like, 12, 13 years. But hey, so that can't go in long life assets, and they'll tell you greater than 25 years. There is a little quirk to that. Again, if this asset is less than £10,000, it may go in the main pool. pool. So the benchmark is £10,000. If the asset is around the £10,000 is less than £10,000, even though it's a long life asset, you can put it in the main pool. Okay, great. So very quickly to summarize, we have this, because I'll end now, I'm almost just over the 10-minute mark. We have this idea of the main pool, and we'll look at examples in a second, or we'll look at the column in a second. We have the special rate pool that I talked about, so we have the long life assets, so things like air conditioning, lifts, high emission cars, all go in that special rate 8% pool, and this is your 18% pool. Then we have these single asset pools, like I said, that where the owner of the business is using an asset for his personal use, and assets that we intend to get rid of within 8 years. So we'll expand on these a little in the next video. Great stuff. See you then.